we built 8 startups, 6 of which were kind of fintech or around fintechs. We exited 2, and we brought 29 investors, okay, with different backgrounds, most of them executives, ex-executives, VCs. So a very diverse bunch. Our first investors in the very beginning, they are having returns that are like 50 times or plus at this point.
Max Pog builds a startup studio.
Hi, my name is Max. I'm an entrepreneur and I'm going to launch startup studios. I invite to my podcast other startup studio founders, venture studio founders, VC fund managers and partners. And today my guest is Carlos Gamboa, a co-founder of Fisher Venture Builder in Brazil. They were one of the first venture builders, true venture builders in Brazil, not just incubators. And they built 8 startups during the last 6 years and had 2 exits, which is amazing. We talked about who are the partners of the venture builder, whom they attract as co-founders to their startups, how they were able to onboard 29 investors to the studio itself. So I hope you will find this interview interesting. Subscribe to my channel.
Max Pog builds a startup studio.
Thank you, Carlos, that joined my podcast about startup studios. And today we'll discuss how you decided to build a venture builder, Fisher Venture Builder. You are probably one of the first venture builders in Brazil, and we'll discuss like how you started, what challenges did you have, and what advice can you give to aspiring startup studio founders. Okay, so
Nice.
please tell me about your path. What was your path to create a venture builder?
Nice. I might not have been like the first or maybe one of the first, because in the past there were some incubators that worked, so the concept was kind of evolving. But we founded Fisher in 2017. In my path to get there was to have a regular corporate life before working in banking and strategy consulting, doing an MBA in between, and then spending almost like 10 years on venture capital and private equity, in things that now, even looking back, there was one big case that was a venture building, but I didn't know at the time, of a biotech firm that we sold to Monsanto. So, but then after this cycle in 2014, I decided to open my own business and to my own venture, and was going into that, and I became an entrepreneur. I founded a marketplace focused on gastronomy, like farm to table model here in Brazil. And I learned quite a bit in the process, especially like to change my mindset from a corporate mindset, or maybe like a regular engineering mindset that most of the people actually do have, into kind of a digital product mindset. That was the beginning. So I made like a lot of mistakes and learned with the mistakes. And one of the key things that I learned is that you're always learning, always testing. So it's kind of trivial to say that here, in the setup. Maybe many of the people who are going to listen to this would say, yeah, this is obvious. It's not obvious to most of the people. Most of the people, especially engineers, would have like a goal. They are a problem, and they will try to crack the problem, to the end. So get all of the solution to the end, and not do all of the steps to keep cracking something that you don't know, which is kind of the product tech like mindset. But at this point, right after I actually founded that, a group of investors wanted to raise like a small venture capital fund and invited me to be the manager. And I was fundraising that fund in 2016. When at some point at the end of 16, I joined I sat with one of my co-founders that I knew from some time, and we're discussing entrepreneurship in Brazil. And we looked at that and said he had just like founded a fintech, and he said, well, there are a lot of problems or pains, in fintech scope, especially in B2B in the Brazilian market that are not being addressed, and you have a gap of technology guys not understanding how corporation works, especially a financial corporation, and the guys in the financial sector not understanding this path to technology. So that was at that time very clear, and we decided to flip it and say, no, well, a fund, you are always like a passenger. It's a different strategy. Why don't we become like co-founders of startups that we can see like the real needs or the real pains in the market, and then together with a team of co-founders on each of them sequentially, found these startups and have like a regular life. And that was I went to approach a group of people who were kind of anchors to the fund I was raising, and they were leaving like the stock exchange. They were the ones who put together the innovation program in the stock exchange in Brazil, were angel investors themselves, and somehow entrepreneurs as well. And that group was kind of the first check to Fisher. So they bought my PowerPoint into doing this sequentially. And that's how it all became. It became with a focus on fintech. It became as something that we wanted to do. We saw like kind of the gap and the opportunity. We didn't quite know exactly, how we would do it, so it wasn't planned that way. But then we went into looking into benchmarks, and also like uh, building our path to it independently. So knowing what works from a VC standpoint, bringing this with what's the entrepreneurial journey that we had as well, and making it work. So we did like many mistakes. We learned a lot of things. We got some things right, and that's the path that we came to up to the moment.
Mhm. So, for the last 7 years, right? Or how long Fisher Venture
Almost
Builders?
that. No, 6 years. Hmm.
6 years. So, how many startups did you create? And am I right that fintech is still your focus, or
No,
there are
it's
other?
not.
Uh-huh.
It's no longer our focus. So we started with that, and at some point in the beginning of 2020, mostly, we realized that what we had built, our capabilities were much more into understanding how to build a startup from a business standpoint, and in all of its pieces, just how do you go about it? What do you do first? What's the first team? How do you finance sequentially? So all of that. So how to build a start was one of our strengths. And the other one was a product tech mindset. So how to build a, a product that's digital and based on technology, or technology based, I would say. And at that point, we ventured into like doing other things, not limited to fintech. But yeah, we built 8 startups. six of which were kind of fintech or around fintechs. We exited two. One was a very early exit, was an insurtech, so right in 2018 or 19. And then in 2021, we had like a sizable exit. We sold a mortgage aggregator kind of platform that we had built with a franchise system. We sold that to Quinto Andar, which is one of the a large startup in Brazil. So we're going into Series A, but then we decided to engage with Quinto Andar, and it all happened. Like there were lots of synergies within the business. So it was great for us, for the investors, for the team. Great case.
Mm-hmm. And the first case, was it like successful exit for investors for you?
The first case was an early exit. We wasn't like something sizable. You know, we basically recovered like the cash that we had like put in. We didn't have investors to win, so it was something that we saw at that point of actually going, let's say, live. You know, with investors. We realized that the journey of the entrepreneur wasn't really in sync with the journey that we envisioned to the startup. So our co-founder was not so synced, and that was an early, start that we did. So a model that today would have done it differently. But in any case, we got into terms for exiting, and it was fine for both sides. He ended up actually pursuing like the case or continuing with it, and even got funded from like a VC. But again, like we had different beliefs at the point.
Mm-hmm. And you said that you saw this gap in corporations that they don't understand how to create new technologies and startups. And am I right that for all of your startups, you partnered with corporations or you started something on your own?
It's quite the opposite. Like we all start up on our own. Like
Ah, wow.
we don't like to partner with corporations. So we use our learning from like having lived, corporate life before, together with our network and the network of our investors. We after the first financial round at Fisher, we opened like a Fisher as a startup for other investors, and we brought 29 investors. Okay, with different backgrounds, most of them executives, ex-executives, VCs, so a very diverse bunch. And we used all of the network and our standard network to go and validate, the problems that we go after, the case in the industry and so on. It's always like we do other validations as well, but our network is a powerful asset that we have, and we basically pursue things where we are the co-founders on a thesis that we build together with a team of dedicated co-founders. We're always like a minority shareholders, very relevant, but still below like the 50% line. And that's how we do it. Our model. What we see in corporations is that um, corporations, they especially in some geographies, they might be more evolved. Some. But in a geography like Brazil, I think that the mindset's not it's not yet there. To have like the maturity to look at this case of building a startup and deciding to go either way, either command and control. It's like I'm gonna fund this whole thing, and I'm gonna have a dedicated team with entrepreneurial mindset, but that would have like a very minority stakehold on that. But that would be very relevant because they're funding everything and so on. But keeping independence, although like being attached like to the corporation, or like the other model would be to really just blow kind of the first air into a startup, leveraging either like industry knowledge or value chain knowledge or um, other asset that would enable that new startup to kind of uh, do the or have their first client or enter in the industry and so on, but have like independent life. So in that case, a corporation would have like a minority stakehold on that startup, and the startup would be fully independent, and even the results would be independent. Like for that to exist, they would have to sell to competitors and really penetrate the industry. Otherwise, they are not like an independent startup. So these are the two models that I believe. And again, like we have cases of corporate venture building in Brazil. We at Fisher, we do act with corporations on a small consulting arm that we have, where we actually got our playbook kind of shaped and fit to be applied into a corporate setup. But in that case, we prefer to be completely fee based and completely on a kind of consultant engagement, rather than negotiating equity or having like an equity uh, participation on those startups. We will only do that if we could have that set of ideas being kind of a feeder. We could be kind of the validators of different theses, and if those would evolve, we would incorporate within Fisher, and that would be a startup at Fisher, with some preferred terms for the corporation to invest. But other than that, I think it's a very I don't like the word complicated because it brings like a lot of I can do it and so on. But definitely it's something that it's not simple like to craft like an equity partnership with someone that would be a corporation that would be maybe a majority shareholder or something like that. Like the value of that it's diminished, and you're totally subject to like the ins and outs or the flow of the corporation that changes executives from time to time, changes their objectives from time to time, and when you are entering like a startup journey, you have to be committed 100% for like the next 5, 7, 10 years. And that's a pretty long span for a corporation for something that, especially in the beginning, would it be either generating profits or not sizable profits, or would be kind of seen as a distraction to, the KPIs of the managers and the executives. So if that governance is not well set, it's a huge barrier.
Mm-hmm. And as you said that you just partner with them if they go to you to get your experience or playbook of how to launch startups, or using you as a validator of their ideas, right? So can you say
Yes.
that that this partnership is like something substantial for your team, or it is just occasional and it is not influencing your revenue streams? So do you think that this partnership is good for you? How much interest do you have from those corporations? So maybe you can give some
Mhm.
orienters.
It's interesting. It's not our major um, line of business. Our major business is actually to have equity in our own startup. So we do a few every year. Our average is slightly over like one every year. We are trying to get processes to improve on that, but it's not something that would be. We are very selective on the things that we are going to be, co-founders at. So it's not like a business uh, per se in terms of it's not a service to startups. We're not an accelerator. We are really like serial co-founders of startups. That's how we define like ourselves at Fisher. But then, like as I mentioned, like we have a consulting arm that has a leader and focus only on serving like corporations in their needs related to innovation, and evolving into corporate venture building, which is like this path of creating either a new product or a new division or even like a startup leveraging their strengths or some of their strengths and a team of entrepreneurs. And that part is something that generates like a revenue for us. It's really not like our main focus, but we do have like good relations and actually very good feedback from corporations we work with because it's very difficult actually to find like in the market people that can do that can be that Sherpa, that guide to like the leadership at the corporation, but with like the knowledge from having done it exactly from having built startups, built like a digital product as opposed to having just kind of a consulting knowledge, which you'll find. So many of the people who work with innovation within like the industry might be either ex-consultants or never have actually built something, from the ground on. And that's a key differential from our side. And we might lack actually, the power of a big consulting firm to just do, like a consulting arrangement. That's not what we like to do. We like to be very focused on solving something that these guys normally don't do it as well as we do.
Mm-hmm. And first, I want to ask about your team of founders or co-founders of the studio itself, of the venture builder.
Mhm.
So, do you have some roles and functions which are divided between you, or you do the same things? And what can you say about the team of founders? Who you believe after
Mhm.
6 years must be in the team of founders of venture builder?
It's an interesting question. Like we had one founder that actually left Fisher and one that joined in between. That happened in early 2020. So the founder who left, he had like a startup, a fintech that was born more or less at the same time as Fisher, and at some point became clear that for him the path was that one. And in the my partner who joined, it's an interesting story as well. Like he actually had helped co-found several startups, and at some point he participated with us as an entrepreneur in residence in one project that didn't go through. Actually, didn't become a startup. But at the end of the project, we looked at each other and said, "Wow, this." He told me that this is more or less what I've been doing. I didn't realize. But you guys are doing it, on an organized and institutional form, and and that's what I want to do. And so we kind of joined force, and very happy to have him on board. as one of our four founders. So we didn't start, Fisher, thinking about what would be the ideal team of founders of a venture studio. So that's an important point because having said that, so I didn't bring like a CTO, a CMO, or I didn't do that mix. But the thing that we have in common is that we all have like a very entrepreneurial mindset. We have like a high tolerance to uncertainty and risk. So kind of pathologically, attracted to risk maybe. And we function well together. And with time, we learned, how to spread, this model into two dimensions. Like one dimension is what each of us does better, and therefore we can do it helping like the other ones with when a case appears for the startup. So for instance, I in every fundraising process of any of our startups, I normally get involved, and that's part of what I do. Relationship with investors, so investor relations is a function that I do as well. And we all like work, but I normally work on a strategy of the studio as well. In parallel, each of us is the co-founder of one or more of our startups. So today, I was the Fisher co-founder for the one that we sold to Quintonda, and today I have like one of them, Go Lisa, as the startup that I'm the co-founder with. And on the path for new like startups, I'm kind of the preferred guy to be, this co-founder. So in that sense, like each of us is deeply involved in like several startups, normally like from one to two at this point, uh, and are involved or ask for help of the other partners for like any of the processes that they might need help. And in that, we are structured in a way that like Danielle, for instance, works on product development more than as like a Pietro. Also, it's like a product development and all the communications, design, and so on. Marcelo, which is our fourth like partner at Fisher, works more on anything that has to do with legal, admin, and so on. But each of us has to do like a full cycle of building, and that's how we function. More recently, we have started to work on like a senior team for the studio on several functions that we saw as kind of key to how we function. So one of them is people, because people at the end of the day is our one of our main like raw materials, like co-founders, first teams. So it's what puts everything together. So we brought like a head of people and community who is doing like an excellent job to help us improve all of this hiring, org design, everything that has to do with how we do it across the board. And we brought also like an associate with great background to be kind of a potential next partner at Fisher, and we are building that line, of senior or more senior people that can either in the future be one of us in terms of getting a piece of the society, or jump into being like an entrepreneur in residence, having built with us like priorly. And that complements like a team of analysts who basically also like work within Fisher in different processes, but but many times also deeply within like the startups, especially in the beginning, as kind of the first team that is helping put the team together. So we use those resources as well.
Mhm. It will be interesting to know what is your role inside of startups you create. So every one of you has some equity in startups, not only
Hmm.
the Fisher venture builder, but you, and you do something inside of it. And it is probably not CEO position because you attract other co-founders. So I want to ask you, what do you do inside startups when you launch it, you as partners of this studio, and also what are your co-founders, so whom you attract as entrepreneurs in residence, what is your ideal co-founder profile, and how do you attract, where do you find those people?
uh, no, nice question. Like breaking it into like from a high level standpoint, like again, since acting as a co-founder, has the meaning that it has to it, like the true meaning of it. It's like you're a founder or you're a team, and you probably know that. Like when we don't hire founders, we partner with founders. So when you're a founder, you basically are you have things that you do, but you're part of the team who share that path. So you also do everything. Um, and so our role in the beginning, starts with even like validating, the thesis. We like to have a co-founder at this point. We might start some early validations by ourselves, but very early on, we try to bring someone who has this profile to be like our co-founder to that side, because like when you do like the validation together, you're starting to like experiment working together. So that's a big point. And we test that. That's part of our playbook. Um, we test how the governance works, all of the intentions, profiles. How do we work together as a team? Because it's going to be important, especially after we have investors. And it's for real. I would say, when you bring like external money, that's where we have like higher stakes. So we test like it quite a bit from that point. And in the beginning, we do act as kind of a besides like co-founder, like a co-CEO of the startup, and or other functions. Like it's a C level that the startup wouldn't have at this point. We act as that, or many C levels, because we bring like the team as well. As the startup evolves, we see like a trend for like the official co-founder to evolve into kind of a executive chairman, so to speak, position, which is someone who is very active still, but more focused on kind of the new strategic paths, or things that are not so close to the daily operation of the startup, but more kind of those next gaps or next jumps that we'll be working on. So that's how we see it, and we bring resources like from Fisher uh, uh, as needed in the beginning. So we have like a way of doing that as well to on those first steps. After the first funding of the startup, the tendency is actually for it to become more and more independent. So we hire the first teams. Sometimes we have gaps that we fill, but this is all temporary. We're always like making each of the startups fully independent. We don't like, a model where you have like a centralized, like a share services kind of methodology, because we see that as always keeping the kind of a crutch, for something that would have to be, performatic, actually being always, at a high performance level. And you asked also like, what's the ideal like a co-founder profile? So thinking of it, in two ways. Like one, we like to, especially when it's something that didn't was not born within Fisher. Like we like to bring someone who has like a specific industry knowledge, or being kind of a master or advanced in a certain knowledge domain, that being either a product or really like a market, in bringing that perspective, besides like being an entrepreneur. And then on that side of being an entrepreneur, we have like a 11-point list. I think that's kind of the last time I saw it. It might be less by now. We're trying to filter it. But in things like the ideal co-founder would have to be um, good, or actually have to bring some dimensions as being like tech savvy, resilient, team player, of course, humble. So we have like a list of things that basically make up someone with an open mindset, or a growth mindset, I think is the right word, and in kind of a resilient entrepreneurial mindset. So those are, open to learn, very resilient, and then there are things around that.
Do you usually bring one co-founder or two co-founders, or it depends?
It depends. Like we have experience with both. Like we tend to as a rule of thumb, like bring two co-founders. It's kind of more than one and less than three, or less than four. So the right number would be two, three. That's kind of the magic number. And then you have like a first team that's incentivized by stock option pool and so on. But if you think about the core co-founder team, one co-founder is always like more risky, and also it's interesting, like brings it's a different balance, within like the co-founding team. When we have three, like Fisher plus two, it actually brings an interesting balance to the whole equation. And you don't have like a co-founder that's by himself besides us. Important when you look at the path going forward. So ideal two, maybe three. More than three is a little messy.
So
And
if there are three co-founders plus one co-founder as a partner of a studio, and also the studio itself, right? So and I want to understand how usually you split
the
shares. Uh-huh.
the partner as co-founder of the studio, the Fisher
Ah, uh-huh.
co-founder, he doesn't have a
Special amount of
special
equity.
shares. No,
Ah,
no.
yeah. Okay.
And
Okay.
that's an arrangement that we've done like ourselves, so that we don't have like preferred startups. It's not.
Mm-hmm. Mm-hmm.
Otherwise, you would have like a misalignment of certain
So
incentives.
everyone will promote his own startup.
Yeah,
uh,
or being kind of incentivized to just do deals, or to maybe even like exit, like a certain startup before of the time, because he's so vested on that. So we when we built Fisher, and more so like over the years, we built a very solid governance among like ourselves partners at Fisher, which I think it's key. Like when you're building like a studio, as with anything else, but especially like a studio where you don't have like it's not like a bank that you have like a semester or biannual, like a bonus or something like that. Uh, we don't have that. It's like it's very low in cash, it's very high in value, but it's a long-term commitment. So it's very important to build or the rules for someone to get in, the rules for someone to get out, and how it functions and things are split in like a daily basis. So we tend more into kind of a more equal ownership among the partners, realizing that contributions are different, seniorities are different, but we all row together, the same boat and to the same direction.
Mm-hmm. And when co-founders come to Fisher, what do they get? So, do you invest some money on the early stages of a startup, and how shares are split? So, I know that you mentioned that you had like 29 investors, if I'm right. And so there are investors in the studio. The studio has some equity in the startups, and how much equity do co-founders get? So if you can explain how equity is split between all stakeholders, it will be interesting.
Mhm. In our case, like we didn't put like a fund together, so we don't have like a studio fund. Like investors invested it in Fisher, so they are our investors, and they might co-invest in the startups when the funding rounds come. It's not an obligation. So in that way, those investors they have like a flow through, and they basically my investors, so they're not directly investors in the startup. Many of them also co-invested in the startup rounds, so they have this true track. Um, when we start like a new startup, the split rule of thumb is like a 60% the entrepreneur, like the executive or full-time co-founders, 40% Fisher. So that's kind of a rule of thumb. And on top of that, you have like investors in the rounds of the startup, so not my investors, and an SOP, so stock option pool for employees that dilutes everyone. So, and what do someone gets when he joins Fisher, to be a co-founder? So it's not like a service. So it's not that someone knocks at my door and says, "Oh, I have like a great startup. I want to do like a studio model here." Doesn't work like that. We either want to do it or we don't, and we direction. Many people who actually come to us with something that's already advanced and don't have like a fit to what we do into where they can find the help that they're seeking for. But when someone joins us in building a startup, he gets a co-founder, basically that would work with them into putting this together, actually validating, uh, find investors. So things that we bring like a lot of value at. We normally take care of the first round of of fundraising. And how do we do that? It's not that we we fundraise, but we have access to either our investors or other networks of investors, and we ease up, a process that's very cumbersome, especially for someone who's doing it for the first time. We've done it many times, many times, more than 10 times, or 10 startups, many rounds. So we've fundraised for ourselves many times. So if you think about someone who is putting together a startup, fundraising by itself, it's a full-time job. That you are a little eased off. You also have you always have like to be the one selling. Investors want to see our co-founders, and if they are the ones who are going to take this idea or take this startup to the next level. So that's indissociable. Like no one can actually bring like a pocket of money. It's not like that it works. But at the same time, like finding those investors and doing like a first pitch. I can do like a first pitch for most of our startups, especially the ones I'm directly involved. I can go there and sell it. So doing that is a huge value add. Second one is guiding through like these stages of where do you get like financial support? Where do you get like your admin stuff done? What do you have to do next? So all of these steps, we have done it many times as well. And putting together the first team, it's something that we also like work very closely with our co-founders and bring expertise into like how do we put together a startup team for what we're trying to do. And we do put some money into it. We normally, on average, we block around 300,000 reais, which is like $100,000. No, but it's relevant to our market to go over all of the expenses of the validation, maybe hiring some of the first teams. So everything that would take the startup to that point where it's ready to fundraise, which is, our first kind of milestone, our big milestone, is when do we all feel comfortable to go to investors, knowing that we have like a case that's investable and has like a traction from a VC standpoint.
Mm-hmm. While we are talking about fundraising, so when you fundraise to the startups, how do you cope with skepticism of venture capitalists about venture building model? Because like when they look at the cap table and see that Fisher has like 40%, they will ask like, wow, it is unusual. So how do you cope with this?
Hmm.
And also I would like to ask you about like how to fundraise into the studio itself. Did you do it only once when you started, or you do it regularly, maybe every 3 years or something like this?
Okay, good two questions. I'll start with the second first. We did fundraise the studio as if we were a startup. So we basically sold shares. So we sold preferred shares of the studio, and that was the path that we realized was the best for us at that point. So it has a limitation because you can't keep doing it forever. So we are looking into maybe going into a model that's prevalent into the industry as well, of creating a fund that invests sequentially into like a series of startups that we put together. So in besides that, like we now have a portfolio that we have an expectation that over time we would have like an exit every 2 3 years, and then we tend to retain from that exit war chest of funding that circles like the money into the studio. So that's how we cope with it. In the startup, two things. Like one, normally at the pre-seed round, or normally we have a round that we bring at least a portion of angel investors. So even investors from Fisher who have been investing with us like sequentially, and we normally bring in also like investors that would be relevant for that startup specifically. People from like industry, qualified angel investors for that. And we bring early on. We try to bring, depending on the phase, also like an institutional, so a VC, early stage, or then later stage. And there is a barrier, for those who don't understand the model and might look at us as like another financial investor taking a piece of the startup. Um, and we go around actually getting them to realize that that's not our role. Like we are on the ordinary shares, so we are co-founders, really like we are entrepreneurs rather than investors. But that's something that, of course, like takes some interaction, takes them to see exactly how we work and operate for them to believe, at least the ones who haven't been in touch with us like before. After we have received an investment from like certain VCs, then it becomes like a different game. Like they already know how we work. They can see how we add value like on a daily basis to the portfolio. How we in moments of crisis and difficulties in the market, we are actually a great asset, in navigating the whole startup through like the stormy seas. As a tenured, multiple time like a founder collectively. So it's kind of a repeated business model. You repeatedly interact and do business with sometimes the same people, around. And after some years, you start to develop like a name, a reputation that helps, in the process. That being said, then two things. Like one, yes, there is still like resistance, but it's getting it's being eased off, especially in the market that we are right now, which is more like harsh. It's more prone to kind of the survival of whoever has like a more structured mindset or have lived through it like more times, rather than your regular like first time founder who might be experimenting this path for the first time. So we are getting like a more positive interactions with VCs. And with the ones that we interact, it's actually interesting that we have like a great a great story together. So and within our portfolio, we have now I think more than six like VCs in different startups, some in more than one. But we're always working on getting the word out and interacting with this network.
Mm-hmm. one question is about those initial investors in your venture builder. You said that they got preferred pool of options. So this means that preferred shares. This means that so there is common shares in a venture builder and also preferred. What is like percentage of the company which you gave to these investors, and maybe
It depends, Max. It's a story that you have to build. Okay, so of course, like our first investors in the very beginning, they are having returns that are like 50 times or plus
wow.
at this point. We did like two batches of fundraising. Like the very first one, when again we were just an idea, we were like a PowerPoint, and then like a year and a little bit, we had like an evergreen round, like a round that lasted like a year and a half, more or less, where we attracted more than the money, we attracted the people that we wanted as kind of a network of investors. And for those, like they bought like a much more goodwill than like the first limited partners.
So
Everyone got converted into shares. It was a convertible note, but 2 years ago we converted into like a SA, a Sociedade Anônima, which is like a C-corp maybe.
mhm.
Um, and with that, like we basically have all the investors having preferred shares and all of the founders of Fisher having like the ordinary shares, as you would do in
Mhm.
other, as if we were a startup, basically.
Mhm. Mhm.
Okay,
And
so they have
so
a
those
minority ownership.
and those 29 investors were in these two batches, right?
Yes.
Uh-huh. Great. It's interesting. I know that in the US, when you create an LLC as a single studio model, so you can.
Hmm.
It is not so simple. So I'm not sure that you can give some preferred action. So it is just a stake of a company, and only C corps allows to create. But C corps is not good for when you're doing exits and you don't need to pay taxes. So it is transparent entity in the
Hmm.
US. And so investors and shareholders just pay their own taxes. But with C corps, it is double taxation. So usually for studios in the US, they create
I
LLCs.
mentioned C corp. I mentioned C corp as kind of a parallel. Maybe it's not the best one, but if you have
Uh-huh.
like a holding company in Cayman, for instance, that's more
Mm-hmm,
maybe
mm-hmm,
like the parallel. You have like different classes of shares, and those have like different rights and
mm-hmm,
you
mm-hmm,
know like the different preferences. So that's a structure that
mm-hmm.
we have right now.
And
I'm not saying it's the best one, but
uh-huh.
it works
If
for
if
us.
if investors have preferred shares, do they plan that Fisher sometimes will be sold as a whole holding, or they just will get dividends or say or sell their shares? So what are their expectations?
They, um, we could potentially be sold. It's very unlikely. It's not in our path right now. But most of the returns they get through dividends, when we have like an exit, or other forms of capital distribution um, in that line, you know. And yes, they could sell their shares like anytime. We actually created, since we didn't want to issue any new share or dilute ourselves. we recently created a program that we call like the new zookeepers, and we have like a we call like kind of the startups at Fisher kind of the zoo, and each of them has a nickname of an animal. So that's a kind of inside joke. But anyways, like so we created a program so that we can have like new investors at Fisher having like a tiny, piece of it, but buying from like some investor who already, has it. So it's a secondary market that we kind of foster in a way in order to attract like a more interesting, like diverse people within like our investor pool, and making sure that we give can give them the same opportunity that we can give to our investors who have some preferred access to our portfolio when we're doing like funding rounds and so on. So we wanted to keep that in a way that we found to expand our investor base, but at the same time not diluting ourselves and not creating governance issues, was to open kind of this path, and we are adding like a true we did like a test. We're adding 3 new investors this month who are buying like shares from like some of our larger investors at a discount to NAVs, small discount to NAV.
Mm-hmm.
But that's like
Mm-hmm.
something that's
Mm-hmm.
going on right now.
Mm-hmm. The last question, Carlos. What do you think is the most challenging thing in managing a venture builder? And what advice can you give for aspiring people? Maybe you can look back and think, what would you do different from your experience? Uh, so what are your learnings from this 6 years of venture building inside
Yeah,
of a Fisher?
it's a great question. Um, and it's in hindsight, everything, it's kind of yeah, I should have done that and so on. It's very very difficult to tell things in foresight or see things like ahead. But one thing that is always a challenge, and you have to do right, is actually invest like a lot of time into getting to know like people, how people function, you know, how what are the incentives, and getting like the time to interact with your potential co-founders prior to launching the startup, because all of that, like who you choose to be your co-founder and how you guys like function together is determinant of how like the startup will evolve within your studio at the end of the day. And if this is going to be kind of a healthy relationship, and with and that's goes with it, like with a nice governance that's mutually agreed, or if something that you're going to have to be spending energy like over and over to fix relationship things, because at the end of the day, people are people, and and you're working with people. So I tend to joke, that I wanted to get to do something with less people involved as possible. People is always like messy, but I wasn't smart enough maybe like to do kind of those lines of code that function by themselves and make money by themselves. So when you're running like a studio, that's part of your day to day. Like you're always getting to interact and manage conflict, manage growth, manage like a design of how teams work together. So that's one. The second thing that I would mention is so maybe invest like today you have like a lot of benchmarks on studios. The number of studios as you see, in Morrow or JSSN and more. You have like a good bunch of them. Think well, like what's kind of the model that works for you, because the models are very different, and it's kind of I would do like a reflection on what you actually want to be doing. What is it like interacting with corporates? Is it like doing 5, 10, startups a year, which brings you closer to kind of an accelerator model, or something like just a few, and you're choosing them, and then have like a very high context interaction, or very deep interaction, and those things vary with kind of the pool of talent that you have within like the geography you're acting, the maturity of that market, things like that. So maybe in places like the U.S., for instance, it's more natural, to have like a more like a ready people coming to you as a co-founder. Like the mindset, it's more advanced in that sense. In places like Brazil, you have less people who are that ready, on average, and that are entrepreneurial and exceptional, and that would have like a fit to a studio. So that's something to consider. That was part of our choice of doing, being more selective and more focused.
Great, Carlos. Thank you very much for the interview. You shared a very interesting story of Fisher Venture Builder. Thank you very much. And what is your advice for all people who want to build a startup studio?
Well, thank you. Thanks for the conversation. Was great. And it's like I was saying, like I think that sharing or getting to know people who have done this path is something that if you're thinking about doing a studio, you must do. People are on average very receptive uh, to actually talking about it, or at least on average. I am. I think that studios are something that are evolving quite a bit. The market actually is opening up to understand, the different models. And as you are doing, Max, like getting to know people who have done it, getting to listen to all the stories, and at the end of the day, see what works for you. It's a great way of actually getting into this field. Getting to do anything, but especially something so crafted and so singular as running like a venture studio. So that would be my advice, which is not like a huge advice, but talk to people, get to know like what they've done, see what works for you, see what you want to be doing, and realize, like last one, realize that this is like a long journey. It's more like a marathon than a 100-meter run. So something that you have to be committed for a substantial length of time.
Thank you, Carlos.
Thank you, Max. Bye.
Max Pog builds a startup studio.